Okay, we're going to look at one more exercise here dealing with bonds. And it deals with early extinguishment, meaning the bonds were paid off early. Now, sometimes that's not an option. If the bonds are callable, that means the issuing corporation can pay them off early if certain conditions exist. Basically, if they decide to. Usually they would pay them off early if interest rates move against them. Meaning they're paying 10% on their bonds and the market rates move down to 6. Well, they might pay off the 10% bonds early and issue new bonds at 6%. So here, exercise 1423 on page 834, which means I need to change that. Okay, let's read through it. It says the balance sheet of Indian River Electronics Corporation as of December 31, 2015 included 12.25% bonds having a face amount of $90 million. Now that 12.25%, of course, is a stated rate. They tell you there the face amount's $90 million. The bonds had been issued in 2008 and had a remaining discount of $3 million at December 31, 2015. Meaning the balance in discount on bonds payable was still $3 million at December 31, 2015. On January 1, 2016, Indian River Electronics called the bonds before their scheduled maturity at the call price of 102. A call price of 102, that means 102% of the face amount. So I hope this makes sense. They want us to prepare the journal entry by Indian River Electronics to record the redemption of the bonds on January 1st, 2016. I hope this makes sense, you guys. Now, not all bonds are callable bonds. Some bonds, if the term says 10 years, then they have to go the full 10-year term. But that's riskier for the issuing company. It locks them in at that interest rate for 10 years. It's better, though, for investors because they know they'll get that interest for 10 years as long as the corporation stays in business and pays their debts. Now, a callable bond is much safer for the issuing corporation. Like we mentioned earlier, if interest rates go down, they could pay off the higher interest rate bonds and issue new bonds at a lower interest rate and save money, much like someone might refinance a home. So here, they've decided to pay them off early. Well, if they've paid off the bonds, and this is January 1st, 2016, if they've paid off the bonds, think about it. What needs to come off the books? I hope you said the liability account, bonds payable. Okay, remember bonds payable always goes on the books at the face amount. So when they're paid off, it would come off the books as a debit at the face amount. In this case, $90 million. Okay. A discount, remember it goes on the books as a debit. It's written off or amortized as a credit. If the bonds are paid off, we'd have to take the discount off the books. And again, it goes on the books as a debit, comes off as a credit. Let's leave room for another debit in case we need it. I'm not sure yet if we will. But the discount on bonds payable goes on the books as a debit, would come off the books as a credit. Of course, the premium works in the opposite way. And they said the remaining balance in the discount account was $3 million. Okay, now we're also to pay off the bonds. They're going to have to give up cash. Cash comes off the books, of course, as a credit. And it's at 102% of the face amount. Well, the face amount was $90 million. Times 1.02. So they're going to have to pay $91,800,000 to pay off the bond. Okay, so on the credit side, we have $94,800,000. And on the debit side, we only have $90,000. Now, when you retire bonds early, or call bonds early, or redeem bonds early, or pay off bonds early, see how everything in accounting has several names? If you pay off the bonds early, then you could have a gain or you could have a loss associated with that early extinguishment of the debt. If you get to this point in the entry and you need more debit to balance the entry, then you have a loss. If you get to this point and need more credit to balance the entry, then you have a gain. You probably remember that from maybe Intermediate 1 or just maybe even financial accounting. Now, and that should kind of make sense. Losses increase on the debit side like expenses. Gains would increase on the credit side like revenues. So here we have a loss because we need more debit to balance the entry. Loss on early extinguishment of, I was going to say loss on early extinguishment of bonds or debt. Your book just goes with loss on early extinguishment. So that's what I'm going to do. I'm just going to do it like this. I'm going to say 91.8 plus the 3 million minus H6. So that gives us a loss of 4.8 million by paying these bonds off early. That still could be to our advantage, though, if over the next few years we'd save way more than 4.8 million in interest. Okay, so that's just one journal entry there, but I think you've seen, well, you've seen bonds, how to calculate the issue price. You've seen the journal entries to record the bonds when they're issued and to make interest payments. You've seen an entry to call bonds early. And then we also looked at an installment note. So if you have any questions on this chapter or anything else, please let me know. I think after working through this one, you should be fine with the Connect Plus exercise 14-23. Thanks a lot, and I hope you all have a great day.